Hello, everybody. This is Manoj Kulwal. I am your facilitator for this IOR webinar today. Today's topic for this webinar is benefits and methods for quantifying operational risk. And we have two experts joining us today. First, we have Dr. Carl Spetzler, who's joining us from somewhere in Canada, a very early morning there. And we have Warwick, who's joining us from UK. Dr. Carl Spetzler co-founded Strategic Decision Group in 1981, and currently he's the chairman and CEO, and he has published and shared a lot on the topic of both decision making at the strategic level as well as enterprise risk management. And Warwick co-leads the SDG energy practice and is also a core member of SDG's enterprise risk management practice team. So welcome, Carl and Warwick, for today's session. We're going to do a 90-minute session today, and it'll be into a discussion format where we will let the speakers sort of present the topic, but then I'll try to make it into a discussion. And then you will also be able to post your questions in the question panel. You'll also be able to post the questions in the question panel, and then if those questions relate to what we are discussing at that point in time, then I'll ask the question then. If they're generic questions, then I'll leave those questions towards the last 15-20 minutes we will leave for Q&A. And the slides and the recording of the webinar will be made available within the members area on the IOR website. Generally, I also do an introduction to IOR and introduction to the operational risk certification IOR provides. I'm not going to do that today, but I have provided the information in the handout section. So if you are new to IOR and you want to know more about the Institute of Operational Risk, or if you want to know more about the operational risk professional certification offered by IOR, then you can download a PDF in the handout section. So with that, let me hand over the floor to our experts so we can get started. So Warwick, you should be the presenter now.
Right, I think.
Okay, yeah, we see
we're ready to go. Carl, yes. Are you ready to go?
Yes, I can see it well. Thank you. Manoj, thank you for inviting us, and we're pleased to speak with this audience. The question of how do you quantify operational risk, or more largely, how do you quantify and deal with uncertainty, and is close to my heart and has been a subject of my study and work for 5 decades. So we go forward. Let me introduce this by asking some of the fundamental questions. It's not advancing on my side, Warwick. Are you advancing? Okay, so we're going to cover 4 topics, and I'm going to start with what is risk anyway, risk and opportunity, the opposites of the coin, and kind of set a high-level context and framework. Then we'll talk specifically about risk prioritization and how we use our analytic tools, and Warwick will talk about that, and I'll come back at the end with some final thoughts. So if we go forward to the next one, let's assume that I'm going to offer to everyone that's online a valuable instrument. It costs you nothing. If you, and here's what it is, you get $20 if you call a coin correctly. The coin is a fair coin, we flip it, if you call it right, you get the $20. And if you don't, the instrument expires and becomes worthless. So the first question is this a valuable instrument? Is it worth something? I think most people would say yes. And then next, if you go to the next slide, the question is, do we have a risk in accepting the offer? Now, it's interesting, in the last couple of years, as ISO 31000 and also the COSO approaches, have begun to redefine risk as including the upside. You find in a risk professional audience, quite a few people say you have a risk in taking this. But anybody outside of that smaller group will always say, no, you have no risk. It doesn't cost you anything. So therefore you had nothing to lose. And a risk in most people's minds is a chance of losing something. So most people would say this is not a risk. And however, now put yourself in the mind, I've just given you that and you now own it. Once you own it, your net worth has gone up by a few dollars, right? Because you could probably sell the certificate. It's worth something. And now when I ask the question, now that you hold it, do you have a risk? People say invariably, yes, you do. Because you have something of value and it may expire with nothing. So this question of when did it change from one to the other has many people puzzled. In fact, when you look at this world of risk-taking and facing uncertainty, the mathematics and the processes don't care whether it's upside or downside. And it would be much better for us to use the word uncertainty if we include the full range, the upside and downside, as opposed to using the word risk and trying to redefine it in people's minds to include possibilities of gain. So if we go to the next slide. So from my perspective, shift your mindset from a narrow risk perspective to a broader facing uncertainty perspective. And downsides are just half of it. Next, we want to look at this picture from an overall enterprise perspective. And that usually means the board is interested in your top risks, and any company in any enterprise has an overall value, which is usually rolled up from the operating business portfolio and the future possibilities and the downside risks. Okay, so there are, and organizationally, this traditional risk management world tends to be what we call the low probability, high impact events, things that would go on a heat map. And there's actually an equivalent and symmetric function in what are the low probability big upsides that we can identify. And often those are your innovation portfolio and R&D portfolio and corporate development, where we're looking for possibilities of significant gain. We're not doing that without cost, so that those uncertainties that are inside the business units, as well as the upside and downside part of the organization, these lower probability events, make up the risk profile of an organization, and we draw that as a probability distribution if you go forward work on that. And the way I think of the whole risk management and uncertainty management of an organization is there is this currently, if you take an organization, we know it's not the market cap. For example, if we take that as the shareholder value in this instance, is an instantaneous number that's just a spot price, okay, for right now. However, it can easily shift in both directions, and if we take it with full internal perspective, what we'll see is that we can get a distribution of the enterprise value. That's the uncertainty in the whole enterprise value, and the job of the board and the CEO and the whole company and risk management is to shift it to the right and make it more narrow. Okay, we draw this little financial and safety risk in there because once you get down to the left tail, there's a slippery slope at a certain point where the shareholder interests can't be met and the bondholders or the debt holders become the dominant, and at that point, when we're in a liquidity crisis or something like this, we're in a different game. So most most organizations and CFOs try to stay way to the right side and not get close to that slippery slope. But the important thing in thinking about this enterprise distribution is that it includes all the upside and all the downside opportunities. It really is made up of many individual risks and opportunities. And the way we would like to really think about a risk is as incremental change to that whole distribution. How much is it changing the corporate total uncertainty picture now? Okay. And that combination allows us then to look at this uncertainty management that is across the whole organizations. It's intrinsic to just about every function. The operating unit functions, the development functions, the IT functions, the cybersecurity, you name it, it's all throughout the organization. And that is why risk management is gaining ever more attention, and people are beginning to think more clearly about managing uncertainty and risk exposure throughout the organization. Within that, we can talk about the role of operational risk. So let's go to the next slide, and I'll just make a couple more comments to pass it to you, Warwick. So the way we think about risk management, there's an identification step of what are our exposures, and usually it's from this protection mindset. We're saying, okay, we're in this business, what could go wrong? It's not what could we find that would make it much more valuable. That would be the other half that goes together with the full uncertainties. Then out of that identification, what we need to do is assess and select how important they are and find the ones that are the big ones. Then for the really big ones, we need to go through a mitigation analysis. Turns out that the mitigation and decision analysis kind of things that you do on the big ones are no different than what you do with the big capital expenditure investment upside decisions. The math doesn't care whether the original question that we have to address came from a protection mindset or a growth and opportunity mindset. Okay, that's why these worlds are converging, and this world of applied decision science that Warwick and I come from, and the world of risk professionals and risk managers is converging, and the tool sets that come from the decision analytic world that we represent are becoming more and more common, and the training is now, we're getting in our courses that we give more and more risk professionals. And finally, of course, none of this works unless it's executed and monitored and controlled. And by nature, human beings do not put enough attention on the tails of the distributions that they face. So you have to constantly work on creating awareness in the line organizations and in the key functions in the organization to put enough attention on the lower probability, high consequence events, whether they're upside or downside. Otherwise, the operating mindset and the near-term perspective that people have to have for execution will drive out considerations of those things. So the monitoring and control, and let me say, awareness raising and constantly reinforcing is a big part of an effective risk management implementation. With that, Warwick is going to spend most of his time on the part 2 and 3 in here, and let me turn it back to you, Warwick.
Thank you, Carl.
Warwick, before we start your section, can I just cover one question on the previous slide where we have that shareholder value graph? So if you're able to just go to that slide, I just want one clarification. If you go to the previous slide where we have the blue.
Just excuse me while I figure out how to get back to it. There we go.
Okay.
This one?
All right. Okay, perfect. Here. So Carl, just a simple question, just from a clarification perspective. So here we are saying the x-axis is the shareholder value an organization is delivering to
Yeah,
his shareholders, and the y-axis is the probability or the likelihood.
it's the
Uh,
frequency. It's a frequency distribution. Yeah,
okay.
correct.
Okay. So the objective, so as an organization, what you're trying to do is you're trying to sort of move that curve on the right-hand side. And
Yeah.
how does that connect to the risk element? So you said there is a slippery slope. If you were just able to
So
expand.
okay. So let's forget this the little red curve over there on the left side, okay, for a moment.
Okay.
But
Uh-huh.
and just think of this as we're a normally functioning organization. We do have a market cap, which is the spot price of that distribution. Okay, so on that distribution would be a point that is today's shareholder value.
Right.
And that shareholder value, however, is quite uncertain. You know, the market goes up and down and so on. Plus, events could shift it tremendously. Something comes out about cybersecurity on Apple, and their
Mm-hmm.
stock price could easily drop by 15-20%.
Yeah.
Okay, and with an intrinsic perspective that you have from the inside of the company with your finance organization and so on, you can create this internal understanding of what is our enterprise value. Now, the full enterprise value includes debt, but let's say the shareholder value part of the enterprise value. Okay,
Okay.
and that's the distribution. That distribution, if I can increase the expected value of that distribution by some better growth, some better opportunities, everything I do that makes things better, increases earnings and long-term sustainability and so on, makes it worth more. The other way you can make it worth more is reduce the left tail and make the thing tighter.
Mm-hmm.
So risk management, which is focused on the downside tail and reducing that, actually increases the overall value. And when the distribution is very wide, then and we're getting into something that probably is beyond today, is the value is discounted somewhat. It's not just the expected value. It gets to what we call the certain equivalent, and the certain equivalent has an adjustment to it that, depending on how much risk there's people will value it at less than its expected value, okay, because they want a risk premium, and so that comes into this. But the whole idea is move it to the right and make it tighter. The financial safety risk is that there is a point when you are sliding down the left side on the scale where you end up getting into liquidity and near bankruptcy or in the zone of bankruptcy, where in fact the legal responsibility of the organization shifts from primarily focusing on shareholders to having to protect the interest of the debt holders.
Right.
And that's what that is. And usually that zone is very closely managed by the CFO, and they want plenty of room and be to the right of that. They don't want a debt equity ratio or something or a debt burden that gets them into that zone. So they overprotect usually the organization from getting into a bankruptcy situation.
Okay. Okay. Yeah. Thank you for that. Warwick, over to you.
Great. Well, good afternoon and good evening, good morning to everybody. Again, like Carl, I add my thanks that we get the opportunity to talk to you here. And before I move on, it's probably just this is a good slide to just reflect on what Carl's just said. And I would note that a lot of what I'm going to talk about are some of the tools that we bring out of the decision science world, the applied decision science world that we work in most of the time. A lot of the content of what we do is really focused on finding, I guess, what we call opportunities. So things that, in a sense, add value to the business. And that's, of course, one way of shifting things to the right. The other things that we call risks, and a lot of what most of the audience here I would think deals with, is this with operational risks. These are negative opportunities, if you like, and what you're focused on is trying to make sure that that we can limit the negative impacts of those opportunities. So in a sense, it all fits into under the same framework, but we work in different parts, if you like, of the space from a value creation point of view. It's protection versus adding to the business, and it all contributes to moving right. And I wanted to sort of use that as a little backdrop, because what I want to talk about is some of the tools that we commonly use. And I'm going to talk about two elements of this, really on the assessment and selection side. So once we've identified a set of risks, one of the challenges that we have is that we often have a lot of them. So it's typically a risk register might run to hundreds or thousands, depending on the size of the organization, risks, and you need to be able to understand, well, which ones are the ones that matter and that we should really be putting our limited risk management resources onto. Where do we need to focus our energy? And I want to talk a little bit about some of the commonly used tools and how we approach these things from a more of an applied decision science perspective. And then in the next section, I'll talk a little bit more about, once we've found these, if you like, high impact, high severity type of risks, then the question is, well, what tools can we maybe share with you to help you think about those? And there we'll talk a little bit more about things like influence diagrams and tornado diagrams. So that's where I'm going with this. Now, as we dive into this this first section here on assessment and selection tools, and how do we think about which risks should we focus on, I want to start that with a quick little poll. Manoj, I think I'll hand it over to you to just do a poll here, but what I'd like to ask our listeners to do is to think about prioritizing risks in your organization, and how is it done? And there's four choices here: either not at all, some kind of ad hoc or subjective approach, using a heat map, and which sometimes people call those risk matrices. It's that sort of red, yellow, green type of classification, or a more quantitative approach like expected losses or things.
Okay, so I will launch the poll now. So you should be able to see the four options. And let's just give you 10 seconds to get enough responses. Okay, so I think, yeah, the responses have settled. So let me close the poll, and I will share the results now. So, Warwick, are you able to see those results?
I'm not seeing the results, actually. Do you?
I see it well, and it's 81% are using the qualitative risk heat map approach, with following 13% are using a quantitative approach that tries to quantify expected loss, and there are 6% that just use an ad hoc subjective approach. Everybody's doing something. Okay, there's not at all.
Thank you, Carl. And to some extent, that mirrors our experience asking this question elsewhere. And Manoj, not too far from the 90% that you predicted would answer option C. So
yes.
So with that in mind, and that gives us a good backdrop into the next part of this conversation. So let's start a little discussion of heat maps, which, as we've just seen from the poll, are very, very commonly used to prioritize risks, and in many respects, they're considered a best practice for this purpose. I've picked a quote here from the ISO organization that talks about the risk matrix or the heat map as a strongly applicable tool for risk identification and risk analysis and risk evaluation. And indeed, it has a number of, at least on the surface of it, big benefits. It's a very easy thing to create. They're relatively easy to assess. So the structure of it is you're really looking to understand a risk event in two dimensions, the severity of it and the likelihood or the probability that it will happen. And we normally use some sort of ordinal scale to put a rating on those two dimensions of the risk. And that ordinal scale can either be, as we've shown it here on this picture, where you use a verbal descriptions, which could range on the probability side for things like highly unlikely to very likely, or it could simply be a scale of, say, 1 to 5 or 5 to 1, depending on which way you run the scales. And that's very commonly how this stuff is done. And they certainly are easy to score in that respect, or they seem to be easy to score, and they improve communication. The challenge of this is that there's actually relatively little theory behind heat maps, and it turns out that they have a number of practical flaws that various people have pointed out. And if you're particularly interested in this, I'm going to refer to a webinar that a colleague of ours, Eric Bickel, who's a professor at the University of Texas, put on, and in fact it's on our website, the reference is there, and there was a paper written on it where they looked into this whole topic in more detail. I don't really want to get into make this a webinar about the flaws of heat maps, but maybe just to point out sort of 4 examples, and this is 4 of a longer list. But one of the flaws that's been pointed out is that there's an inconsistency between the rating of the risk. So sometimes if you do your rating on a heat map, and you also at the same time do your quantitative ratings of these things in terms of something like expected losses, what you find out is that what you will find is not infrequently a more severe risk in terms of its expected loss lands up getting a lighter rating, so it might be a yellow, when something that has less impact or less overall loss in expected terms lands up being a red risk. And there's certainly clear cases where certainly the paper and the webinar can demonstrate that. Another dimension where heat maps or risk matrices are oftentimes flawed is what we call range compression. And I'll give an example on that in a second, but the essence of the issue in range compression here is that when we set those ordinal scales up like 1 to 5, behind them we don't always have a consistent, we don't have equal buckets of value. So if you talk about a scale of 1 to 5 in terms of impact, we might say that 1 is 0 to 10 million, 2 is 10 to 50 million, 3 is so on, and then 5 is greater than 100 million. And you can see that 5 bucket encompasses an enormous range of potential value, whereas your first bucket maybe only covers 10 million. And you get distortions that arise from that. Another one that often comes up, and I'll mention it because I don't talk a lot, we won't talk a lot about cognitive biases in this seminar, but one of the things that obviously impacts anything to do with risk management, anything to do with quantifying and thinking about risks is that people have biases in the way that we think about things and the way that we assess things. And one of these biases is that when people are dealing with, particularly with these ordinal scales, we tend to avoid the extreme value. So if you get a survey on the airline asking how good your flight attendant was on a scale of 1 to 10, we tend to avoid rating them a 1 or a 2 or a 10. Right? We tend to focus on something that says, they're not perfect and they're not wholly bad, but we tend to have that centering bias, and that has implications. And then another potential flaw that was listed and demonstrated in the Eric Bickel's work was you get some very strange behaviors if you decide to rank your scale 1 to 5, where 1 is sort of the mildest impact and 5 is the most severe impact, just by simply changing the definition of that and making it 5 to 1, where 5 is the mildest and 1 is the most extreme. And you do that for both the impact and the likelihood, you can land up with different rankings in your heat map. And that's also a bit disturbing. So the bottom line is that there are some really practical flaws with heat maps, and we need to be quite careful about using them. And at the same time, there's relatively little work that's been done on them. So we know relatively little about exactly how to solve these problems, whether they can be solved. And so we move forward with some peril. Just to give a quick example of the range compression inconsistency, we'll take a little example here where we have two events, A and B, let's call them, and we've got our heat map here, and B lands up, A lands up being an event that, say, has an $11 million consequence if it happens, and a probability of about 6%, which puts it into the red zone in terms of our heat map here, whereas B has got a much bigger consequence. So it's still in that top bucket from impact level, but it's got $1 billion consequence, but only a 5% chance of happening. So actually, in terms of the heat map here, B looks like a less severe or less critical risk than A, but if you actually assess those in a more mathematically precise way, it turns out that your expected loss from B is obviously a lot higher. And there's a second example here, which I won't go through the details of, but the same thing. Again, you can have, they both rank the same now, but you've now got a situation where even though they're the same, you can actually see that from a potential loss point of view, event D is much bigger issue, and you'd want to spend a lot more time thinking about event D than you would about event C. So why does this come about? It comes about basically because of the way these buckets are defined. That the distinction between $10 and $11 million event, which is just into the impact level greater than 10 million, and being $1 billion, which is way into that bucket. This is the sort of thing that one's prone to here, and I'm not sure that this particular inconsistency, for example, that there's a systematic way that's been developed to sort this out. So we need to be careful about this sort of thing. I thought I heard maybe there was the beginnings of a question there or a comment. Carl,
No,
did you have something? Oh,
not
okay.
from my side. No.
Okay, so the question is, so what should we do about this? And now there's probably multiple things one could do, but I'd like to take the perspective that we would bring from the decision sciences, and just make the quote here from the academic paper that was written here on the risk of using risk matrices. And the caution that Thomas and Bickel and their co-author make here is that we need to be cautious about using risk matrices or heat maps to make decisions of any consequence. And in the context here, that probably means we need to be very careful about using these heat maps to distinguish between those alternatives, or all those risks that sit kind of in the upper right-hand corner in that red zone, orange zone. We need to be mindful that they don't always help us to make clear decisions around which risks need to have the most attention put on them, and which ones we really should be focused on. I would say, as an aside, though, that they're probably pretty good at helping us to screen between sort of the broad distinction of what's maybe green and we can kind of put aside. And so they may help us at a very high grading, triaging approach to working our way through our risk register. But we do need to be careful when we're getting into making real allocation decisions in terms of how we spend our time and our resource dealing with these. And the solution they suggest, and it's one that we would be aligned with, the best chance for providing high quality risk management decisions is to apply the tools and processes that are embodied in decision science. And indeed, we've been using these tools in our domain for, well, as Carl said, he's got 5 decades in this. And so there is roughly that 5 decades of really practical applied experience of taking these tools and using them to quantify uncertainty and to make decisions around that quantification. So as a starting point, maybe just a suggestion on how you might start with this. So in our risk registers, we can modify them relatively easily to start using more of a quantified approach to assessing both the likelihood or the probability of events happening and the monetized statement of their consequences. And really what it takes in the first instance is, instead of thinking about likelihood ratings on scales of 1 to 5, low, medium, or high, and impact ratings the similar way. On the likelihood side, we'd want to replace those with just a little bit more precision, at least precision in the language, by putting a probability number there that the risk event will occur in a given period of time. And on the impact side, again, you've got a couple of options there. You can either think about this in terms of just putting an estimate of the average monetized loss that might result from the event, or you could be sometimes that's more challenging to do than even just putting a range there. And of course, the range it captures the uncertainty that does exist around these things. So we can put a range in there, and there's different ways you can assess that. Some people like to just put two numbers in that give a confidence interval of 80% or 90%. The way we tend to work in our work is we tend to ask subject matter experts for what we call P10, 50, 90 assessments of the loss. And very simply, that's 3 points that reflect three possible outcomes. The P10 would be the low end case, where we say there's probably only a 10% chance that it's less than that. The P90 is the sort of opposite of that, 10% chance it'll be more, and the P50 is roughly equal. And the main point I really want to make about this is that this doesn't have to be extremely intensive or extremely it doesn't have to be massively time consuming, I think, because in the first instance, what we're actually doing here is that these are subjective assessments, right? There's nothing necessarily objective about coming up with these numbers. Sure, we can over time collect data, we can build models, we can do all sorts of things to try and give us more insight into what these numbers should be. But in the first instance, we'd be doing the same thing that we're really doing with our ordinal scales, which is taking some kind of mental model that we have in our heads, and we're expressing it in a different form. So instead of expressing it in an ordinal number on a scale of 1 to 5 or a low, medium, high type of output, we're just going to say, well, let's express it as a probability or a range of potential range of monetized loss. And I frequently get the objection when I do this with clients. I work a lot, to take an example, I work a lot with engineers when I work in the upstream oil and gas sector. And the question that I'm often looking for there is something along the lines of, well, how much would, say, a new pipeline cost? And the answer is always something along the lines of, well, I don't know. Well, can't you give me a range? No, I just don't know. I have to go and talk to suppliers and have to get, this is what comes out. But in the end, you sort of say, well, is it going to be for free? No, don't be ridiculous. It won't be for free. Will it cost $1 billion? No, that's also ridiculous. It's nowhere near $1 billion. And there you're off to the races. And then after not much longer, you find that the expert can normally pull a reasonable range out, say what's going to be between, say, 100 or 150 million. So these things you don't need to go to the vendors and work up studies to get these estimates. These are experience. You're getting subjective assessments from experts or knowledgeable people. Right. So how does this help you if you do this? So essentially, you could think about now your risk register that's been rewritten into a form where you've got your events. And for those of you, apologies to anybody who has come from the oil and gas sector who's listening, these are pretty much made up events, made up probabilities and outcomes, but they illustrate the point. So we would start with a risk register where a basic assessment, instead of ones to fives, we've just put a rough probability on there, and we've put maybe a single estimate of the, if you like, the potential expected loss the average loss we might see from a particular outcome. And we can do a very simple calculation, and I think everybody is capable of doing. We multiply the one by the other, and we get an expected loss. And these expected loss numbers really give us a pretty good feel for the overall impact or the overall significance of that risk in your table. And so it's very easy then at that point to sort this table and produce a quick prioritization of where your big risks that you need to pay more attention to are. And so we've illustrated that here. And it's the way that these numbers have fallen together, it's clear immediately that these top two issues, top two events of a blowout or a rig failure may be the things that you want to spend more time on. And then you could think about whether you've got resource to start really focusing in a deep way on further things. Quick comment on this is Carl touched on the issue of risk appetite and a little bit earlier, or risk tolerance. We talk about it. These numbers that I've shown here are just pure expected loss numbers. We won't go into it today, but it is possible without massive amounts of additional work to be able to do an assessment of the organizations or the senior executives or the board, if you like, to understand some basic parameters around about their risk appetite or their tolerance for risk, and you can adjust these numbers to reflect that. So if you have some level of risk avoidance or people don't want to take on the expected value of the risk, you can adjust those numbers downwards, and then you can create exactly the same charts.
Well, since they're negative numbers, they would be the total you'd be willing to spend would actually be more. It's kind of like how much more than the blowout expected value would you be willing to spend to insure against it fully? Okay, and you might be that might be 15 million. Okay, so that's why insurance companies can make money, is that we're risk averse. If everybody was willing to play the averages, there'd be no gain in between.
Yeah. So, and Carl touches on another point that's sort of caught in the footer there, which is that by quantifying things in this way, it also gives you an upper bound on how much you'd be prepared to invest to mitigate or fully offset the risk, right? So now you've got some sense of the scale of investment that it might be worth making. Now, obviously, you may not be able to fully control it, so those really are an upper bound rather than what you would be prepared to spend. But broadly speaking, it gives you a much better sense of what might be reasonable amounts to spend in managing risk, if you like.
And work on the previous slide, you mentioned on the impact, the probability 10, 50, and 90.
Yes.
So on that example we were just talking about, is that where then you will have three columns for the event, the impact size column? If you just go to the next slide.
Yes, absolutely. So, and in fact, if I go to the very next slide, you'll see that I've put two of those columns in. So here perfect. I've just used a P10 and a P90 range. So you can express your event as a range, or you can put a third value in. It's probably worth saying that what you're doing when you're putting in that P10, 50, 90 is some theory that was developed in the academic world, and as well as a practical thing, but there's been some academic work done on it as well. We tend to use that, we call it a discretization, if you like, of a probability distribution, okay? Because what's really behind there is there's some distribution of value that happens on, say, severe losses. And we don't want to get into a situation where we're sitting down with experts and trying to ask them whether it's a log normal distribution and what the mean of that distribution is and how many moments of the second moment, what's the value for that. That's not the kind of discussion we want to have in the sit-down conversations with your subject matter experts who may not be statistical wizards. What you really want to do is be able to ask something really simple like, well, can you give me a range on this, or can you give me a P10, P50, P90, which pretty much anybody can do. And then it turns out that with some fairly robust assumptions, you can turn that into a distribution, which you can then do some of your uncertainty and probability modeling on. And then we found that to be very robust. I mean, if you're in other worlds, people tend to use a P30. Sorry, they discretize slightly differently. So there's different ways of doing this, but the main point is that you would take 2 to 3 values, and then you let the maths, the statistics. You don't need, and you shouldn't. We don't want to insist that in order to use these methods that you've got to be a statistical genius, or that you've got to be even statistically literate to a high degree. So that's really what I wanted to illustrate on this chart. So I've taken the exact same losses, and I've looked at it in a slightly different way here. I said, well, let's say we've got some information to do with the event outcome that's now a range, which gives us a little bit more information about that outcome, that it's not just one single value, but it gives us a range. We've still got the probability of the event occurring. It has the same expected loss that I showed on the previous page. But one of the things we can do when we've started to express our information this way is that we can create some more pictures that are quite useful. So one question that comes out of this chart is, you can do Monte Carlo analysis, and I can see lots of eyes glazing over at this point. But again, let's not get stuck on the fact that there's some statistical work behind what you'd have to do here. But you can take these numbers, and with some fairly general, fairly robust assumptions, which are also, by the way, fairly generally and fairly robustly embedded in very user-friendly software, and you can create a chart that looks like the one on the right-hand side, which is got various names. You can call it the loss exceedance chart. You can call it the inverse cumulative probability distribution. But the essence of it is, it's a chart that tells you very quickly and easily the distribution of losses that you could experience as a result of all of these risk events playing out together. In this case, I've assumed that they're independent of each other. So the interpretation here might be where I've drawn there is a 30% chance that the total loss exceeds $40 million. And that gives you another visualization, another tool where you can start having a conversation with your management, or you can start thinking about, well, how acceptable is that? And we understand the expected total loss here, which might be about 47 million. So if you're an organization facing this portfolio of risky events, this would characterize it. And I think about one of the ways you may use this, if you take your risk register, and your risk register has some information, your risks are different by, say, take types of risks. So for example, we might group all our cyber risks together, or we might look at risks in a particular part of a particular geography, a particular part of the world, or risks in a particular department or business unit. You could actually generate these sort of loss curves in those chunks, and that can also be quite insightful as you start to look at your business and you understand the pieces of it, or the particular types of risk that threaten you most. And so, for example, you may find that your cyber risk curve here looks a lot more severe than a lot of your others. That may suggest that that's where you want to spend quite a bit of time and energy, and you may want to set up a cyber risk team to even think about managing this whole risk. So that's the other maybe useful output of that. So I'm going to move on to the next section in a minute. Manoj, it may be good to see if there are any further questions on this section before I move on.
So there are a couple of questions here. So I think the first question is on whether you have seen this sort of methodology being applied in operational risk on financial services, on things like data breach or cyber risk or business continuity type events. Have you seen sort of organizations apply this to those type of operational risks within financial services?
So, Carl may have a different answer, but I think in the interest of being completely honest here, my domain that I focus on most of the time is not financial operational risk management. So I haven't seen a lot of that domain in general. Mm-hmm. But having said that, there's two other comments I would make there. One is that I think that we do a lot of this, and we've applied a lot of this methodology to very analogous problems where you're looking at portfolios of opportunities, where you have lots of different opportunities that you may want to combine together, a whole set of projects, for example, which have all got their own little way. They've got their own little foibles of how you would define them, how you get your head around the value. They've got complexities of uncertainty around how to measure things. So yes, we've seen plenty of examples in that respect. And the other thing I would probably refer you to is, I've referred to it a few times through this presentation, but Doug Hubbard is someone who works quite a bit in the risk management, operational risk management area, and has done is also steeped in the decision sciences. He's written a few books on this. I think the famous one he wrote was How to Measure Anything. But he's written a more recent one, which is, I think, something to do with, I've actually referenced it at the end, how to measure cybersecurity risk. So yes, this stuff has been applied there on things like cybersecurity risk events, and I'll point to an example in the next section, actually. Carl, you had something to say here.
Yeah, let me say that the kind of operational risk considerations is probably most evolved in the financial industries. Already in the 30 years ago, we were analyzing the potential of getting into that slippery slope and bankruptcy situation due to correlations among loan portfolios. And it wasn't so much the individual risk in a loan, it was the correlation between, so for example, one big bank had a big portfolio for ocean transportation, particularly of oil and tankers and things like this. At the same time, had a relatively big investment in certain kind of oil companies, and they considered both of these very independent. But when you got their correlations into the risk, you ended up having a much bigger risk exposure than they had understood. So it's both applied on the operational level specifically. And the main thing that I see coming out of what Warwick just said is some of the heat map thinking is okay. Just turn the two axes into number estimates of probability and consequence. And if you do it in numbers, and preferably absolute impact numbers, not some kind of percentage change, then you will find that you can calculate expected losses and you can do all kinds of better understanding. And remember, this part is still in what we call the selection assessment stage of which ones do you really want to go after with a full decision analytic approach that Warwick will talk about next.
Mm-hmm.
Yeah.
And what if we apply, sort of just take one example of, let's say, data breach. So hackers stealing your customer data was the event in that table on the left-hand side. And the probability of that is, let's say, 60%. So on the P10 and P90, because what you may have is the hackers may either steal, let's say, 100% of your customer data. So if you have 10 million customer data, they may steal all 10 million records. Or if you detect that incidents quickly, then maybe you'll only lose a few hundred, a few thousand records. So your financial impact will vary depending on how many records they are able to steal. So what would P90 in that case mean? That I'm reading the graphic on the right hand side. We're saying 39% chance the total loss will exceed 40 million.
So let's be clear. Let's be clear that the graphic on the right-hand side is not plotting the distribution on, say, the very first loss there, the severe losses, right? So that's okay. that's not plotting the distribution of value between the 2 and the 5 there. What I'm plotting on the right-hand side there is the distribution of loss over this whole portfolio of things. So everything from severe losses to poor cement. If I wrap those all together, I'm looking at that portfolio of risks, if you like, and saying this is the loss that I could expect on this portfolio. And in this case, I've made the simple assumption that these things are independent of each other, that we can fix that with the kind of correlations. We can put in some information on correlations that Carl was talking about just now.
Yeah. And Manoj, let me say that example you just used of that cybersecurity, I would probably first break it up into multiple events, because when you describe it as this broad characterization, the impact is really from a couple million to maybe hundreds of millions, depending on how big the bank or how big the institution is. I think I would probably talk about different kinds of breaches, and I would base that on Here's what institutions have experienced. Looking back, things have been increasing in terms of scale and frequency, but so have been the ability to impact. And today, a breach is just like another announcement. In 5 years ago, some of those breaches totally ruined your brand, and you'd have a huge brand impact. So you have to think through both what are the consequences today of, and try to get to this quantification, try to get some lookalikes that people can relate to. People have a very hard time with abstract things, but they can really relate to examples and stories. So if you say, look, here's the example of what happened to bank of such and such, okay? And let's make that type of an event an event. And here's another one. And so you create a family of events. Otherwise, it's just too big of a category these days. And it's one of the huge categories for almost every financial or even consumer retail institution. The fact that those data breaches occur make everybody very skittish.
Yeah. So I think this is a great sort of segue into the next section, because I actually have a little tool. We actually address this issue of a cyber breach, just to give you an example of how we would play this out. But maybe as a setup for that, remember what we've been talking about here is taking our full set of our risk register, if you like, and starting to try and prioritize it and understand which ones to focus on. And in the first instance, maybe you don't need to make the distinction between you lost 10% of your data and you lost all of it. We just need to understand that if you have a breach, it could be anything from not so bad to really bad. And that should give us some indication that that's something we probably need to put some more effort into, both into understanding whether, in fact, what does it really look like? How is the distribution of, is it closer to the lower, the not so bad end, or the really bad end, and what do we need to do to mitigate it? So what we're going to talk about in the next section actually is starting to think about, and I'm going to skip that slide for the time being, come back to characterizing and understanding the risk of particular events. So once we've kind of done some of our screening, the next step here is to start saying, well, how do we understand these things a little better? And what are some of the tools that we could use to help us with that? And I'm going to talk specifically about influence diagrams and tornado diagrams, which are two things that we use very much in the decision analytic world, which helps us to get much more understanding of different alternatives that we have. So I think to start framing this now, in fact, sorry, there was one other comment I wanted to make. If you just look at this funnel that I've drawn on the bottom of this slide here, typically in that identification phase, you're probably dealing with thousands, potentially thousands of risks. And you're going to use your screening technique. Maybe your screening has got two steps to it. You may do some triaging of it, and you may just filter out a bunch of things that you can immediately identify as green, and some lower criticality yellow ones. But when you start getting up into that red and some of the yellow ones, you may then want to start really putting the expected loss, at least the initial high-level assessments on those, and that sort of then helps you to understand what are the top 20 or so. And that's where you start moving over into this kind of step 3. What are the top 20 or so that we need to start putting a little bit more effort into? And some of those, it may just be that we need to really understand more about what are their outcomes. We need to do a little bit more investigation into our understanding of the quantification of them and understand really whether they're as bad as they seem. And then a subset of that, and it may be, we've thrown the number up, maybe 10 or so, but it will vary depending on the situation. There may be some subset where you really want to do what we think of as decision projects. And the frame for a decision project here is that you've now found this risk or this event that is severe. It has big consequences. It's got enough probability weighting against that consequence that it says we need to pay some attention to this. And we've basically got some choices to make. So we can, fundamentally, it's a choice around how we mitigate it or what mitigation strategy we follow. On the one extreme, you could say, well, we do nothing. We just let it be and we'll accept the risk. And if it happens, it happens. Or we may come up with some mitigation strategies, and they could be different ones, and they could focus on different things. They could focus on reducing the likelihood that it will happen. They could focus on mitigating the consequence if it does happen. They could focus on just simply ensuring the risk. So there's various things you can do, and I'm sure you will know more about that in your specific space than I do. But this is a very standard decision problem that we deal with all the time in decision analysis. And the basic approach that we have here is to do some analysis. So you want to take your problem, you want to look at it, you want to build some structure. You want to structure that analysis. You want to understand kind of what the different factors are that are going to get you to that value or that loss. You're going to build some sort of model around that. And ultimately, from that model, we're then going to create some visualizations or displays, if you like, of what's happening. And I really just want to talk to you today about the tornado display, which is one of the displays that comes out there. A number of others that I've mentioned there, and more than that even, but that's for another day. Today, we're just going to talk about a tornado, because a tornado is very, very helpful and very, very powerful tool in helping us to understand that for a given problem or a given event or a given opportunity, if you like, it helps us to understand what are the specific things that really drive the value. What are the key value drivers? And if you can focus your energy there, then that really gives you opportunity to think about where you need to focus your mitigation efforts and what is and isn't possible. So I'm going to give you a little bit of insight into what these things are and how we might use them. So just coming back to influence diagram is the first tool. And I've used a simple example here that I've actually borrowed from, I made the chart, but it was based on the text of an example that Doug Hubbard gave in his book on how to measure anything in cybersecurity risk. And the essence of this was, the risk is that you have some loss from an unpatched server. Okay, so that's a very it's a difficult thing to kind of get your head around from a quantification point of view, but influence diagram is a tool that we use commonly to help us structure the kind of thinking here. And the essence of it is to try and decompose this into things that can more easily be managed in terms of collecting data and getting our heads around. So this is not a definitive answer to this problem, but it hopefully gives an understanding of it. So influence diagrams generally got three types of node in it, and all three of them are in here. The blue octagonal node is what we call the value node. So this is ultimately the thing of value, in this case, the loss that we might experience from having an unpatched server. And the oval ones are uncertainties. These are values or quantities or events that are uncertain, that will have some relevance or some influence on that value. And then the final shape that we often have in these diagrams is the rectangle, which is a decision. So these are the things you can do. So in this case, it could range from doing nothing to various mitigation effects where you have teams of people keeping an eye on things, or you spend more money on security, etc. And the idea of these diagrams is very, very easy to work with teams. We work with lots and lots of teams of people all over in different industries. And I've had clients that call these just gazinta diagrams. You can whip these up on a whiteboard. You don't need any maths. You don't need any real quantitative skills to start thinking about the structure of your problem here. So in this case, we've structured it very broadly. That first question you would ask them, a loss from an unpatched server. Well, what is the actual losses that you might experience there? Well, that may come from a couple of sources. One source is potentially that you lose some system availability. There's denials of service. You get downtime on your system, and so that's maybe one category of losses that comes from an unpatched server. There's another category which we've lumped together here. We could break it out separately and make it a bit more detailed, but we could talk about breach of confidentiality or the integrity of the system. So we lose some some confidential data, or somebody modifies something in the code or in the data, and that causes havoc. And then you can just keep working your way out. So in terms of your system availability loss, maybe the things there that are important are the cost per hour of an outage, and how long will that outage be? And we work our way back, as a rule of thumb, we work our way back to a level where we think we can understand this, and we could reasonably ask some experts for assessments, for reasonable assessments. So I think it's a lot easier to go and ask somebody what the cost per hour of an outage is and the duration of the outage than it is to go and say, well, what's my annual loss from an unpatched server? And so this is the idea here. I've got some bubbles in there that talk about the probability. So we may have the probability of the unpatched server event. And given that you have that, there's a probability that it's an availability problem or a confidentiality integrity problem, or maybe both, right? And then that impacts ultimately the losses that you'd experience. And then on the right-hand side, we've just sort of teased out another layer of influences or factors that could influence the value of your breach of confidentiality or integrity, which may be things like legal fees you have to incur, or cost of breach investigation, or maybe compensation that you ultimately have to pay. So this is a first step where we can sit around and start to decompose the risk or decompose the opportunity and understand where the sources and the relationships between them of the value is. Now, the bad news is that I didn't, in the preparation of this, have time to work this through into a full example. So I'm going to flip very quickly into an example that I did have worked up, which hopefully is easy to get your head around. And it's just simply a property investment. So we're going to look at the value of a property investment that you already own. Very simple to think about: rental income, operating expenses, finance costs, and some of the things that drive those different things, like rental income. How quickly can you escalate the rent? What's the cap rate or the capitalization rate? That's your sort of rent to property value ratio. Inflation rates and financing costs and so on. And your strategy here may be things like, continue with the investment or sell. And that's how that would feed in. So where do you go with that? Once you've got an influence diagram like this, it becomes possible to now start talking about getting assessments from relevant experts. And it's easy to see quite quickly that you might be asking different people different things based on their expertise. So one of the real benefits of mapping out your problem this way is it helps you to see really quickly that the guy that you're going to ask about refinancing interest rates is probably not the same guy that you're going to ask about operating expenses, and similar. So you can use this to help identify who you need to get assessments and inputs from. And when we go and ask for those inputs, we typically basically are going to do this in that same format we talked about earlier, just a simple range of 10, 50, 90 values on people's assessment of where this could be, the vacancy rate, rent escalations, and so on. And sorry, Carl, were you about to?
Yeah, I'd like to chime in here. One of the things that, especially in the risk management world, is important here is when we talk about assessments and work is getting subjective assessments from experts, we want to provide those experts with as much grounding in realistic data and facts as possible. So providing a lot of comparables, providing analyzing the large data set on certain things, and bringing outside information from outside the company as well as from inside. Okay, so don't think of this as a separate from data analysis, but the data analysis should be thought of as informing the judgment, because all decisions and risks that we're trying to look at are in the future. And the number one question you have to ask is the future like the past. Some of the biggest mistakes in the financial services industries have been made by taking a large amount of frequency data over short periods of time and confusing the volatility with long-term risk trends. and so it's kind of like the bounce of the needle as opposed to is the needle slowly shifting. Trying to get the assessments grounded and well understood, and on the really important ones, even providing databases and constant scanning to the outside and panels whose job it is to assess certain kinds of, let's say, political risks and country risks and things like this that go into the operation of a financial institution is very central to the organization. Okay? And
Thanks,
to doing this well.
So collecting these inputs and this information is one step to building your model, but ultimately we end up building a decision model. And again, these don't have to be massively complicated things. They can be quite simple. In our world, we typically build these models with spreadsheets because it's a very flexible tool. But of course, in different domains, people have developed softwares that make it pretty much simple to just get the assessments and plug them in to the actual software, and then it produces all the displays that you would like to see. One of the things I was thinking about as I was preparing this, I got to thinking that one of the differences I think between the operational risk management world and the strategic decision world that we spend a lot of our time in is that the strategic decisions are by their very nature very one-off, bespoke, unique kind of decision situations. Not always. Many of them are, it turns out, people are making these decisions over and over in different contexts. But a lot of the time we end up having to get our heads around a fairly unique problem. Whereas I think in the risk management world, a lot of the risks that you face in something like operational risk in the finance world, after a while you're starting to see the same, not the same values and the same numbers, but the same kind of things. So we know we need to start thinking about cybersecurity breaches, for example, and I think it becomes when you've got these things that are repetitive and you're seeing them over and over again, you really can start building approaches and tools to tackle these things. So it becomes possible, I think, to build some of these decision models. You build them once and you use them many times for different contexts. And indeed, I think even within the risk management world, there are softwares out there to deal with certain kinds of things and quantify some of these things. So we would certainly, just to build on what Carl is saying, that certainly you make use of data when it exists. You make use of structures that have already been thought through, if you like, influence diagrams that are already embedded in softwares. You can start thinking about how over time you would build up your capability to do those things. So the next thing I want to talk about is a thing called a tornado diagram. And this is one of, this is a key output that you can generate from a model like the one I've just talked about. And I'm going to spend a little bit of time just explaining how this works on the assumption that some, if not many of you, haven't seen one of these. And if you've all seen one, well, forgive me. But if you remember what we did in the inputs is we've got for each variable in the model, we've got a P10, a P50, a P90, or if you prefer, a low base and a high value. And essentially what we're doing is if you build a model that effectively takes every value, sets it at its base value, and then it does the calculations that you need to do to calculate the net present value of, say, this property investment, given the various values of the parameters. In this particular case, it gives us a base value of $203,000. And the way this chart works is you can see we've got the scale along the top there from 0 to 300. And then at 203, we've got a line, which is the axis going through, that is what we would call the base case value of this investment. Okay, and what we mean by base case value in this instance is that all the variables are set to their base value. Now, once you've created this number, it becomes possible to think about, well, what would happen if we do some sensitivity analysis on that? So let's start with our rent escalation rate, which in the base case is 0. Let's just perturb that one variable, and let's say instead of a 0% escalation, we had a -3% escalation, and leave all the other variables at their base value. We'd recalculate the value of the investment, and it turns out to be, I can't see precisely, but you can see on the scale that the left-hand end of that top bar is somewhere around about 120,000. And likewise, if we switched it, instead of putting it in its low case, we made it plus 3%, and it went to its high case, we see it's almost 300,000. So that gives us a really, we can then plot that graphically and say, basically, the variance that we have, or our uncertainty around the rent escalation parameter, really drives the value of this this investment from somewhere around 120,000 to about 300,000. And we do that individually with each of the variables in the problem. And of course, there are softwares that can do this automatically and produce nice charts, but we do that with all of them. And then we organize the chart from the biggest swing, the longest bar, if you like, to the shortest bar. And that's why we call it a tornado chart, because it has that that sort of tornado shape. I had a few clients that love to call them the whirlwind chart, but it's that same idea. You have this, or a vortex diagram, I've heard it called. The interesting thing about this is that, without getting into the maths behind it, but you see that column on the right there where we talk about the cumulative investment value, or NPV variance. It turns out that the way this works mathematically is that, and if you've assessed 10, 50, 90 values, more or less, then the total amount of variance or uncertainty that you have in your net present value as a whole, about 47% of that is explained by just the variance and the uncertainty that we have in the rent escalation. And if you add another variable, you explain about 79% of the total uncertainty around the value, NPV. And so you're now at 80%, and there's just two variables you have to look at. Add the third variable here of inflation rate, and we've hit about 95%. So you can see pretty quickly that if you're going to now focus energy on really managing the risk, or increasing the value of this investment, or decreasing the loss, if you're looking at it from a loss perspective, then you need to focus your energy on those top three factors. And some of those, in many cases, you'll look at those and you'll say, well, some of those I can control and some of them I can't control. So inflation rate is generally not something that I can control, but I certainly could control the vacancy rate, and I may have some control over my rent escalations. And equally important here is to understand what's not at the top, right? So frequently I may find that, so in this particular case, operating expenses, which is something that most businesses are very focused on managing, it turns out it doesn't really make a lot of difference to your overall value relative to some of the other things you could do. So this is a very powerful tool to understand what matters and where you need to put your energy. And it can really help you in the definition of mitigation strategies, for example. And you start, it gets you thinking around, in this case, it's more about an opportunity and investment value. In this case, I might start asking myself, what can I do to help drive my vacancy rate in the right direction? So I had just one other example here, which came from a piece of work I did some years ago, and I wanted to sort of highlight it as a potential way to use tornadoes as well. So what I've been talking about up till now is really taking a single risk out of your risk register and working it further to understand how you might mitigate that particular risk. It strikes me that these tornadoes might also be quite helpful in helping you to identify risks in your business. And one of the ways that I sort of saw this was a few years ago. I worked for a business that makes fish meal and oil. So basically it's a horribly smelly business where they take fish off a boat and they mush them up and boil them. And I think basically my wife wouldn't let me come into the house unless I changed first after I'd been to this plant. But this was an interesting project because we just modeled at a very high level what drives the value of this business. And it turned out that, you know, when we built a basic 5-year model of the value created by this business, it's of the order of 99 million of value. And then we built the tornado based on what the various players in the company had said around the potential variance of different parameters in their business. And what we got here was this rather interesting tornado that showed that the fish meal price, which I think everyone understood was the big driver, as in most commodity businesses, of what drove their value, but their fish meal yield, and the amount of meal that they export rather than put into the local market were the next two important variables. And in fact, this entire business was completely focused on getting additional value by managing costs. And in most cases, these costs don't make much of a difference. Even if you could manage them to the lower end of what they thought was possible, it didn't add a huge amount of value to the business. Whereas if you could make a small change in your yield, or if you could start exporting more of your product, that would make a big difference. And in this particular case, I got to come back and have a look at this 12 months later. And the team had been very focused on looking at those two variables, and they'd asked themselves, well, how can we do that? And with some fairly simple changes, they doubled the value of the business in 12 months just by focusing on different things. And I think there's an analog here in the risk management world that if you can understand what it is that drives you deeply into loss, you may be able to start identifying things that you hadn't even thought of before. That you may be able to start saying, well, these are the things that could drive us the wrong way, and start paying attention to those. So I don't know if we want to stop there and have some questions, but that's the end of this section, and I'll hand it back to Carl.
Well, I think this would be a good place for having further discussion.
Yeah. So, well, we have one more question, so I'll just read out the question. So, are replacing likelihood ratings with estimated probability actually fixing the problem? Estimates are equally problematic, as it can lead you into thinking you can predict the future. So I think this is, again, just a human bias, right? That once you start putting more numbers, you think, that, yeah, it's more accurate than the risk heat maps you had, that it can create that perception. So how do you address that?
Let me speak to that for a moment. So when someone says it puts you into the belief of you can forecast the future, we have no choice but to forecast the future. That the really dangerous thing is to think you have any kind of precision in your forecasting the future. So one of the big biases that humans have is that we believe more than we know that we know more than we do, and we don't stretch our ranges wide enough. So we're often surprised. In fact, there are many demonstrations when people have calibration training, that before you have calibration training, 50% of the events fall outside your 1090 range instead of only 20%. So number one is we're going to have to look forward into the future to anticipate what might happen. We want to quantify it. Quantification doesn't really add precision when you make it in terms of ranges and uncertainties. It's just stretch them wide enough that you really capture 80% of the actual events in your 1090 range. And when you get to low probability, high consequence events, you really have to go and work. That's a whole methodology in this that has been developed for nuclear accidents and nuclear reactors. And really, that was the early part of this application. But it's a big field. There's a lot known about how to quantify and anticipate the future probabilistically. What you can't do is to do it deterministically. People want to be deterministic about the future. It's just human nature. We want to assume the complexity of uncertainty away.
Yeah, and an observation. So something I like about the influence diagram you had earlier, Warwick, around the patching of the server, is that that's a one-time exercise, right? That you don't have to do that if you're assessing your risks every quarter. You don't have to create that diagram. That maybe the numbers and the ranges may change every quarter. So even though this diagram may look like a lot of work, because if you have to do that on your key risks, it's a one-off exercise. But at least it allows us to demonstrate that the risk owner, do they really understand the risk? Because if they were just doing this on a heat map and they say, oh, the impact is very high, we don't really know what have they factored into their thinking. But if we actually get this sort of a diagram from them, then we can see whether they've factored in the legal fees, they've factored in the compensation, which may need to be paid to the customers. So I think it just gives more confidence on whether the person who is doing the risk assessment, do they really understand all the aspects of that risk.
So Manoj, I mean, absolutely agree with everything you've said there, and I think it also just speaks to the point I was making about, I think in the operational risk management world, is that you have quite a lot of potential to do this kind of structuring once and then be able to use it over and over. I think often in the work that we do, we end up building a complex influence diagram that can never be used again because we only had a one-off decision. But I think you're often, you're continuing to deal with cyber risk or losses from unpatched servers. So once you've structured the problem and you've got a reasonable way of thinking about it, then it is, you don't have to do that very often unless the world changes and the whole structure of the computer system changes.
Yeah. And what I also we saw from the poll that majority are using heat maps. So again, we sort of highlighted some of the weaknesses on the heat map. But what the message I'm taking away is don't stop using the heat map. That heat map is a good first stage prioritization tool. So use it to prioritize that if you end up with 100, 200, 600 risks, then if you want to just prioritize, okay, what your risks are, then risk heat map is a good, simple, basic tool, but don't stop there.
Yeah, and I would say you can, the high level fix that came out of Warwick's presentation on heat maps is turn the two dimensions into scales. One is probability of loss, and actually, numbers, and the other one is expected consequence of loss. Okay.
Yeah.
If of the event. So if both of those, and the expected consequence you might get there from a 10, 50, 90, for most situations. For the early selection, you don't need any more precision than that. For the later, then when you pick out the ones where you say, look, though, and they keep rolling. If you're in the risk management function in an organization, you pick out our top 5 we're working this quarter to an influence diagram and tornado charts and really getting big data, and they stay. And because many of those are come back again and again, next quarter you add a couple more. So over time you build a portfolio of risks for which you have pretty good influence diagrams, reliability and relevance in terms of database for informing your judgments, and have the models, consequence models ready. So you build that portfolio of competencies in an organization, and usually the risk management professional might be working with certain functional parts of the organization or geographic parts that then become co-owners and understand it and have a common language of dealing with it. That's really the big power of all of this.
Absolutely, yeah. And we are trying to get to the stage where we have to decide, okay, how much money are we going to spend on managing this risk? Are we going to spend $500,000, 10 million, 100 million?
Yeah.
And how do you make that decision if you don't know from a quantification perspective how big the risk exposure is? So I think it's before we spend millions, it helps to go beyond just that risk heat map stage. Okay, let's drill down at least on our key big risks. What that quantification looks like. And I saw, so Warwick, you've got us on the resource slide. So that was one of the questions which just came up on any recommendation on further reading. So do you want to just talk us through this slide?
So Carl, I think we're in your section. So why don't you?
Well, okay. So let me just say the decision quality book does not require a lot of, mathematical understanding. It focuses on how do you reach a high quality decision, and it's universal. It's beyond risk management, but it applies exactly to those kinds of selected out examples that we would then go and do a full decision analytic effort on. And it's very accessible and easy to understand. The Handbook of Decision Analysis, that is a collection of decision professional contributions that was put together by Greg Parnell and one of our partners, Steve Tani, and others. And I think it has some very nice resources. Obviously, most people have heard of How to Measure Anything by Doug Hubbard. When he says measure, and this is, I'm sure, what's controversial, but what made the book really sell well, he means judge. And in this, at the center of everything we do about the future, we don't have any measurements from the future yet, okay? So all of our measurements are present and past, the way I think of measurement. But he includes making high quality subjective judgments for the future that are unbiased and that are well weighted. How you get those judgments, if you include that in measurement, that's what Warwick was calling assessments and things like this, then there's nothing you cannot quantify. If you can think of it, you can quantify it. It's not like we have to give up because it has a brand impact and nobody knows how to measure brand impact. Nonsense. All of that stuff in our world is you can come up with good judgments, and they're better and clearer when you put them into numerical terms, okay? Not just big, small. And then there are lots of resources. The Society of Decision Professionals is focusing on this topic more and more. The conference in Denver that's coming up in next March, you can look it up under the Society webpage, will be focusing on the integration and interaction of big data and AI and the whole data analytics and how you move that, how do you connect to that with a decision perspective, okay? And then SDG, just for your information, gives a certificate with the University of Texas at Austin. And this certificate requires 6 two-day courses, some of which are now available online, and more will be coming online so that people can earn the certificate without having to go on campus. But of course, being in person is a bigger and better experience. So those are some of the resources I want to highlight.
Excellent. Thank you. Thank you very much for that, Carl. So we've come to the end of our time. So a big thank you to Carl and Warwick for coming and sharing this guidance. And I'm sure we'll, invite you again in the near future where we could, expand into some of these tools we talked about today. Thank you to everybody who attended and stayed with us. So this is the last webinar for this year. So we are in the process of creating new sets of webinars, which will get published onto the IOR website in January. At the end of this webinar, you will get a question on any topics you want to recommend for future webinars. So if you are interested in any specific topic, then please do provide your feedback, and we'll try to then find expert speakers from around the world who can come and speak on those particular topics. So thank you very much for participating in the webinar today. You all have a good Christmas break, and I'll see you again in a webinar late January, early February. Thank you.
Bye now.
Thank you very much all.